Okay, welcome back in this video where we are talking about pricing strategies, okay, or pricing techniques. And like I said in the previous audio where we talked about the full cost plus pricing method, where we said that in the full cost plus method, what we are doing is we are considering all the cost of production, whether fixed or variable. We are putting them all together to come up with the cost of the product. However, uh, in marginal cost plus, the accountant would be excluding the fixed costs because they say that fixed costs are irrelevant for managerial decisions. Okay, why? Because at the end of the day, the manager has no control over them. Okay, they are always have to be met, whether we do any production or not. For example, we have to pay rent, okay? We have to pay telephone bills, we have to pay water bills, even if we did not produce any product. So by the end of the day, the proponents for marginal costs, for marginal costing, they say that fixed costs are irrelevant. All right. Uh, Let us just illustrate this with this example. All right. Let us just go through this particular example. All right. A product is the following cost, as you can see, that's the data there. All right. And then fixed overheads are 10,000 per month. Budgeted sales per month are 400 units to allow the product to break even. Determine the profit margin which needs to be added to marginal cost to allow the product to break even. And break even is the point where break even is the point where we do not have a loss or a profit. Okay, that's the point where we are not experiencing a loss or a profit. So this is when total contribution is equal to fixed costs. And when we talk of contribution, I'm sure you know that contribution is equal to selling price minus marginal cost or minus variable cost. Okay, so when we have selling price and we deduct variable costs, we arrive at contribution. Okay, we arrive at contribution. Now we arrive at contribution. Now we are saying that BE, the break-even point, is when this contribution equals fixed costs, which means there is neither a loss nor profit. Okay, now let's elaborate this fact with this example. Let's go through this example. Okay, now at the break-even point, okay, at the break-even point, the 10,000 fixed overheads, okay, equal to the 400 units, these ones, because the budgeted sales per month are 400 units. Okay, equals 400 units multiplied by the selling price minus variable cost, and in this case the variable cost is $15. Okay, variable cost is $15. Why are we saying selling price minus 15? Because we are saying that This is the formula for contribution, because contribution is equal to selling price minus variable cost. All right. So, and this one is the fixed cost, the 10,000. This is the fixed cost. Fixed cost should equal to contribution, and the contribution is this one, the total contribution. That's why these are the units. So if we multiply the total units with the contribution, we get what is called total contribution. And these are total fixed costs for the month. All right. So we have to solve this equation. 10,000 is equal to 400 SP minus 15 multiplied by 400, that's $6,000. $6,000. All right. And if you take, if we add 6,000 to both sides, we are going to have 16,000 is equal to 400 SP. Okay, 16,000 is equal to 400 SP. Therefore, SP is equal to what? If we divide both sides by 400, 16,000 divided by 400, we can see that SP is equal to 40. That's the selling price. Okay, that's the selling price at which, because the question was saying determine the profit margin which needs to be added to the marginal cost to allow the product to break even. Okay, now that we have got this figure, we have just to move on a little bit to determine now the profit margin which needs to be added. Okay, how do we do that? All right, profit margin should equal to the selling price. Okay, selling price minus the variable cost, that is the contribution. Okay, that's the contribution, which is 40 minus 15, all divided by 15. Okay, all divided by 15. All right, multiply by 100%. Okay, which means if you use your calculator, because we need the profit margin that will lead us to a break-even point. Okay, and by saying profit margin, we are referring to a percentage. This should be a percentage, so that is why we are multiplying it by 100. So we get 25 over 15 multiplied by 100, and we use our calculator. 25 over 15 multiplied by 100. You can see that this percentage should be let me just erase a bit here, because if it is in decimals, we can just put it to the nearest whole number. So that's 167. That's the profit margin. Now, you may ask, how do I know that if I put 167, if I charge or add 67% to my cost, my marginal cost, I'm going to arrive at a break-even point. Okay, What is the marginal cost in this case? What was the marginal cost or the VC? Okay, the variable cost. According to your calculation here, the VC is this one. Okay, it's given here. That's 15. This is where we are getting the 15 from. All right. This is the 15. Okay. So if we add 67%, is the same as multiplying by 167 over 100. And 167, this is the 167 we are talking about. That's the 167 we are talking about. So 167 over 100 multiplied by 15, what do we get? 167 over 100 multiplied by 15. We get 25. And this is the 25 which we have already found as the fixed cost. Okay, this is the same 25 which we have already determined as the fixed cost as well as the contribution. This is the fixed costs. This is the fixed cost as well as the contribution, because 40 minus 15, this is the selling price minus 15, the variable cost, that's the contribution. So you can see that that's the contribution as well as the fixed cost. And if you are not yet convinced that it's fixed cost, you can also prove it by, we are given the fixed cost here in total, fixed cost in total, and the units produced. So to determine the fixed cost per unit, it's just saying 10,000 divided by 400, and I'm sure you are going to get 25. I mean 10,000 divided by 400, that's 25. So the correct percentage, the percentage margin is 167. I hope you have been helped with this computation. All right. If you like this video, please, if you have enjoyed this video, please click the like button below, or follow us on our Facebook page, as well as to visit our website. Okay, and make sure you enroll with us for further ACCA lessons at all levels. Thank you very much.